which is called the Neo Infra Income Opportunities Fund. And this is a mezzanine fixed income opportunity which looks at infrastructure oriented assets, predominantly in roads and renewables.
Sure.
Right? Now, this obviously is a combination of InvITs and SPVs with fully operational kind of assets.
Yeah.
But before we deep dive into what this means from an investor perspective, talk us through the opportunity and why this presents such an exciting investment for investors.
Lovely question. So that's where my love with asset management started, I would urge all of you, whenever you're free, read about this company called Brookfield Asset Management. It is one of the world's largest asset managers. Brookfield owns buildings in New York, it owns gas pipelines, it owns airports, it owns all infrastructure assets. Globally, if you look, asset managers own infrastructure operational assets. In fact, 45% of operating infrastructure assets the world over are owned by asset managers. Why should they be owned by governments? Why should they be owned by developers? Because their balance sheets cannot take longer duration assets, right? Very simple. When I was in school, very basic: invest for the long term, invest in assets generating stable cash flows, invest in assets that give you a hedge against inflation. Just go through all the tick marks. Operating infrastructure, we are not taking any construction risk. It generates regular cash flows. Where are the cash flows coming from? Government counterparties, and largely the central counterparties, right? Third, it is an inflation hedge. Plus, it is an asset for the long term. As an individual, I would love my assets to be parked in the long term, where I can earn steady cash flows and make great returns. So that is what fascinated us at Neo about this opportunity. Now, had this opportunity, the good thing is this opportunity is so large that we are still very new to this opportunity. This is an opportunity worth, it requires 8 lakh crores of investments in the next 5 to 6 years.
Wow.
That is the amount of infrastructure that is getting built in India. Just roads and solar require 3 lakh crores of capital to be pumped. Currently, who's putting this money? I think a lot of foreign investors are just fortunate. They've seen this evolution curve play out in the US markets.
Yeah.
In the last 10 years, Nitin, large foreign investors like Actis, GIP, where Abhishek, who is the fund manager of the strategy, actually comes from,
Right.
KKR, Brookfield, they have put $50 billion in core infrastructure operating assets. They've already done this. They've put money into assets which are running, which are fully operational. They've packaged those assets, then they've sold those assets or are holding them to maturity and generated 18 to 20% IRRs on an actual basis. Can you believe this? This has been happening in India at a size of $50 billion. But these are foreign investors doing it for foreign clients. We at Neo want to do the same thing in proven sectors where this opportunity is massive for domestic clients.
Right.
So we want to offer a unique saving product to our clients. As you rightly said, it's mezzanine debt. But in essence, in my simplistic world, it's putting money into great assets which are generating cash flows, where your counterparty is the government of India, and where potentially you have a chance to make 18 to 20% estimated returns by buying these assets and holding them. So yes, that's the motivation, and that is what excites us. At Neo, we want to deliver products, where we can channelize savings of our country into some of these assets. I keep telling this. Equities is an asset class. I think foreign investors came into India early, 95 to 2005, 2006. Post that, this is a domestic market. 2006 to 2020, I think the entire SIP movement, I think domestic savings is getting channelized into equity. I see similar shades of reference between credit and what we are doing to equities. 2012, 15, 20, a lot of foreign capital has been coming into these sectors, right? Because they're seeing these opportunities. They're seeing India is evolving. Our regulatory landscape is evolving. They've been there for the last 10 years. And now at Neo, we want to be the forefront of channelizing domestic savings into some of these strategies. This is the SIP movement, in my view. And I'm hoping we can be the torchbearers in that.
No, absolutely, you're right, because you are literally talking about democratizing infrastructure assets
Absolutely.
for individuals and stuff like that. Would be lovely to hear about maybe a couple of case studies
Sure.
on this fund and how you exactly aim to go about it.
Absolutely. So as Nitin said, I think what we are trying to do in this fund, which is the Neo Infra Income Opportunities Fund, it's an income generating fund. It generates 8 to 9% interest dividend on an annual basis to investors. So it gives you regular cash flows. And on a 6-7 year basis, we are trying to generate total returns of 18 to 20%. Let me give you, so we are doing privately listed InvITs. A lot of you are familiar with InvITs, have invested in a PGCIL InvIT, which is a publicly listed InvIT. We are doing a privately listed InvIT. For example, there is currently the NHAI. The government itself is monetizing road assets, right? NHAI is the government's body for monetizing road assets. NHAI has a privately listed InvIT,
Yes.
which is largely available to institutions.
Correct.
It's a beautiful piece of asset, and typically individuals cannot own that asset. We as institutions can own that asset. Currently, a lot of Canadian investors are owning that assets. A few insurance companies in India are owning that assets. It basically is a pool of operating road assets, which the government is selling. You get a chance to buy that at an entry IRR of say 12.5%, Nitin, which is supremely healthy. The government here is your counterparty. And then the very fact that this InvIT is still privately listed, there are several benefits that will play out.
Right.
3 benefits if I can highlight. Obviously, the InvIT will add assets. That itself will get growth. So your IRR goes up from 12.5 to maybe a 13.5. The second bigger benefit is, currently the InvIT is only 50% levered. In India, InvITs can lever up to 70%.
70%, yes.
So when you acquire more debt and acquire assets, your IRR actually bumps up even more.
True.
So that will give an even bigger fill up to IRR. Third is from a governance perspective. In an InvIT, the most important thing is who is the sponsor of the InvIT. Here, the government of India is the sponsor. We are extremely comfortable with that. Anybody should be, right?
Yes.
And the most important thing is currently this is privately listed. Tomorrow it might become publicly listed. Private to public, we all understand that there is a capital appreciation that plays out, right? Because the hands of ownership change.
Yes.
And which is why there is a lower discounting. So there is a high degree of making capital gains on this. The other thing is you are entering a road InvIT which holds assets of 20 years in duration. Just simplistically, Nitin, think of it. You are entering a 20-year bond. It's not a bond, it's a mezzanine debt.
Yeah.
At 12.5% IRR, where the duration is, where the maturity is 20 years. Tomorrow, if interest rates go down by 100 bips in the next 3 years, 4 years, 5 years, and we don't want to be in that forecasting business, you will make huge capital gains on this. So our view is it's a great asset to own. Government of India is the sponsor. We can estimate it make 16-17% IRRs by just owning this access and providing access to our clients through our funds to own these assets. Right? Let me give you another example. I think you wanted one example of where we are trying to buy an operating road.
Yes.
So we are, the number one bidders on one of the road projects. We've been at that road for the last 3-6 months. It's a beautiful stretch of 27.5 kilometers. It's an operating road. We are buying that asset at an estimated value of somewhere between 180 to 190 crores. I'm not giving the exact numbers. The beauty is that that asset is already generating revenue of 50 crores a year. 50 crores a year, cash flow. Who is your counterparty? NHAI, right? You buy this asset, and if you put these numbers on an Excel, right? Mm-hmm. If you put this revenue, you deduct the expenses, and you take the cash flows, right? Obviously, it will be funded through a combination of our fund capital and cheaper capital from banks, because in banks, you can get debt against operating projects, right? Typically 2:1 debt at close to 8% on an operating project. The combined IRR could be as high as 20 to 21% IRRs. And this is on an operating road. Conceptually, Nitin, what are we trying to do? We are trying to buy assets from developers, from the government at close to 10.5 to 11.5%. Just think of it. Earlier, investors were buying buildings and flats at a rental yield of 9, 9.5. Then you went and did a LRD with a bank at close to 8. 2:1, you got leverage. Your returns bumped up by 2% to 11, 11.5, and then you made capital gains. It was a physical asset, generating cash flows, good, healthy returns, right? We are now replacing a building with an operating road asset,
Right.
where the opportunity is even bigger, even sweeter. We are buying it at 11%. I go to a bank, I tell the bank, NHI is your counterparty, give me leverage. Infrastructure projects, 2:1 leverage is a very, very healthy norm. You get leverage at 8, you're earning this spread of 3%. That spread is no longer left in commercial property. So here you have an asset at 11 acquired from a developer. Why does the developer have to sell it? Because his balance sheet cannot hold this for the longest period of time. They have smaller balance sheets, right? So here you buy it at 11, you do the leverage at 8, 2 times, spread of 3, benefit of 6, 2 into 3. So you reach at 17% IRRs. Once again, 17% IRR, great asset, 15-year asset. Tomorrow when we sell this at 13, 12, 14, we will make capital gains. And that's how your combined returns move to 18 to 20% IRRs.
Right.
The good thing is, in my view, these, once again, it's built on the premise of providing long-term capital. And that's where cost of capital advantage comes. You buy from a developer whose cost of capital is very high. We are buying it at a discount from him, and then we are going to do an InvIT out of this or sell it to strategic investors. Right. So we are moving from the cost of capital chain, and that is how we are adding value. As I said, fundamentally, the act of putting money should generate money first.